commercial real estate insight from Capital Economics. Independent analysis, proprietary data, and direct economist access to keep you ahead of the cycle.
Welcome to The Weekly Briefing, a podcast from Capital Economics. I'm David Wilder, and this is a special episode all about the 2026 outlook for commercial real estate worldwide. Yes, it's that time of year when economists finalize forecasts, headline writers go on about crystal balls, and everyone tries to pin down the forces that are going to shape the next 12 months in macro and markets. Capital Economics is not immune to getting caught up with the seasonal tradition, but rather than churning out weighty 2026 outlook reports that don't get read, the team has been holding back and forth with clients to distill their concerns, highlight what they think will be the key themes for 2026. On the real estate front, the team's been talking to investors around the world about what they should be watching out for, where to find outperformance, and where is going to lag. And to discuss what they've been talking about, I've got Kiran Raichura, our chief commercial real estate economist, and Amy Wood, our senior real estate economist, on the line. Hi, guys.
Hi, David.
Hi, David.
Kiran, let's start with you. You've spent a lot of 2025 understanding, but also explaining to clients why the recovery in commercial real estate has been so weak. Is that tone of that conversation, is that likely to continue into 2026?
Yes, that's exactly what we're expecting. It's been, like you say, a very slow recovery so far across the globe, and we're expecting more of the same next year, which, on the face of it, doesn't sound very interesting, maybe. But yeah, I think it's a really interesting time in the market. From time to time, you see the odd piece talking about a strong recovery in volumes next year or a strong recovery in prices in certain sectors next year. That whole kind of story around next year will be our year that, as a sports fan, I'm very much used to. But we don't think the conditions are in place for that kind of recovery. So yeah, we're expecting to see much more of the same next year that we've seen this year, just a pretty slow, gradual recovery in both investment activity and prices.
So one thing we have developed over the course of this year is some capital value lead indicators across the numerous markets, regions that we cover. And in general, they kind of support the story of a slow recovery. So for example, in the Eurozone, our capital value lead indicator points to capital value growth slowing into Q1 2026. So these indicators are based on the performance of real estate equity prices and different survey indicators. And really, in the UK and Europe, they seem to suggest that the cyclical upturn may have already peaked.
What's holding back the recovery? Amy, you were briefing clients earlier today in one of our drop-ins, one of our short-form online briefings. You were talking about this gulf between what sellers want and what buyers are willing to pay. Is that a roadblock to recovery still when we look at markets worldwide?
Yeah, definitely is the case in APAC and in Europe. This gap between buyer and seller expectations for pricing is really one of the reasons why investment activity has been really quite slow to recover, and it is something we would expect to continue next year. In Europe, there's really been lack of distress that might have in the past helped to bring these gaps in expectations into line. So, for example, MSCI data show that there's been less than 2% of sales resolving a distress situation in Europe, and that figure was more like 8% in 2012. So yeah, really, we would expect that to continue to hold back the recovery in investment next year.
So not enough of a shakeout going on, but perhaps in the US we have seen progress on that. Kiran, let me jump back to you because the Wall Street Journal had a column this week titled "Commercial Real Estate is Getting Too Cheap to Ignore." I know that's a drum you've been banging for a while, but how cheap is it? Is that a US story? Is it a worldwide story? And even if it is cheap, frankly, does it mean the investors are taking note?
It's a global story, but the global story is dominated by the US in terms of our global forecasts. And it is really the US that is driving that to a degree. When we look at relative value of commercial real estate, we're obviously looking at other asset classes, predominantly equities and bonds. And our view at Capital Economics is that the S&P 500 valuations are looking stretched now. So if we look over a 5 or 10 year basis, commercial real estate stacks up favourably against the other asset classes, largely because we don't expect bond yields to move very fast. So the total returns from that asset class are pretty steady at like 4 to 5% per annum. And for the equity market, as I said, we expect the US market to drop back over that kind of 5-10 year period, albeit not consistently over that period. But that does mean that on a relative basis, total returns for commercial real estate stack up pretty favourably. If we look beyond the US, then that picture is a bit more kind of evenly spread between those asset classes. So commercial real estate doesn't maybe stack up as favourably. But yeah, what that does mean at the same time, we're talking about a pretty weak recovery. And I think for investors, that means there's a relatively low opportunity cost of not being in the market right now on commercial real estate side. So, you could argue against the need to kind of invest now, even on that relative basis. But what I would say is that, now is the time, therefore, to, understand what the leaders and laggards are going to be in terms of sectors, regions, markets, and, right size or kind of reposition portfolios to kind of prepare for that and make sure that you're in the sectors and regions that are going to outperform rather than those that are going to underperform. One of the things we've seen in recent years is that there's massive differentiation between cities within countries or between sectors, and it's really important that investors are in the right ones there and definitely either underweight or not at all in those weaker ones.
Yeah, and I do want to get into that, but before I do, you said that we're not expecting bond yields to move much, but if we're looking at 2026 and the years after, talk a bit more about the sort of the interplay between what's happening on the rate side and how that's affecting the market outlook, and maybe plug in a bit more about just in terms of the economic backdrop, how far that's going to go to support returns.
Yeah, so broadly speaking, it's the economic backdrop that really underpins this slow recovery. So, we can talk about valuation mismatches and cash still being in existing funds. But ultimately, the reason why that's happening is because there is this not particularly helpful backdrop on the macro side. So if we think about growth, then we're expecting GDP growth to be pretty low across the board, below trend certainly in almost all markets we look at. And at the same time, we think interest rates in terms of long-term bond yields are going to be at or close to their current levels. So normally when we reach the bottom of a cycle and in a recovery phase, we see a big drop in interest rates, short-term rates, but that drives falls in bond yields. And then commercial property looks more attractive. And we also start to generate some GDP growth as lower interest rates boost consumer spending and business investment and so on. But so none of those conditions are in place this time. So, we think long-term rates are going to stay close to their current levels. We think GDP growth is going to be low. So we don't expect to see a strong yield-driven recovery in prices in commercial real estate, and we don't expect to see a strong rental growth-driven recovery. So that kind of underpins this kind of story about relatively low total returns for the sector over the next 5+ years.
Amy, with all that being said, we do have, I look at our rate forecast for 2026, we do have the Bank of England cutting interest rates more than most expect. We do have the ECB cutting European rates by more than consensus. So is that going to help the outlook for those markets?
Yeah, so yeah, you're right. We do have interest rates, short-term interest rates, that is being cut by more than markets would expect in the UK and the Eurozone. And that means we do think 10-year government bond yields out there will fall over the next year or so, most notably in the UK and Germany. But unfortunately, we don't think it's that much of a good story because really it's not going to allow that much in the way of yield compression, as the small decline that we do expect in government bond yields is only really just enough to bring the spread with property yields back to more reasonable levels. And in some markets, particularly in the Eurozone, we actually expect government bond yields will continue to trend higher. The most notable one is France there, where fiscal concerns are really expected to continue to push government bond yields. So yeah, unfortunately, even though we may expect some small falls, we don't think that's going to do much in the way of supporting property values.
Kiran, can I go back to this point you were making about, the property's cheap, but it's not enough to get people off the sidelines? I wanted to get more of a flavour of the mood among clients, if that makes sense. So this idea that yes, property's cheap, but it's cheap but not compelling, I guess, is the story you're saying. Is that the mood that you're picking up from conversations with clients?
Yeah, I think that's exactly what we're hearing. So, people are talking to us and kind of looking for guidance, as you'd expect. And, we're telling this story of like relatively weak recovery, but property looks attractive on a relative basis. But yeah, investors are very much searching around, trying to understand where the best opportunities are. But yeah, they, like us, they're very much kind of bought into this story about long-term rates staying high for the kind of medium to long term now. And so that, suggests to them, as it does to us, that we won't see much of a recovery in prices. Certainly one of the key factor really that came out of our in-person roundtables we hosted a few weeks ago, when we asked clients, what the biggest determinant of returns would be in 2026, something like 75 to 80% said either short-term rates or long-term rates. And in fact, more than 50% of the total said long-term rates. So, everyone's kind of telling this same story. Obviously, there are other factors, but fundamentally, the key story that tells us that, real estate returns won't be especially strong at the kind of all property global level over the next 5 years or so is this story about relatively weak growth and high long-term rates.
So it kind of comes down to finding, as you said, finding the outperformance within the market. Amy, looking worldwide, I know it's a big question, but just give us a couple of examples of where we might see the regions that stand out, and perhaps also those regions that aren't going to do as well.
Yeah, so I think I'll start in Europe because that's where we've got quite a lot of diversity in markets. And the markets that stand out to us really are those in Spain. I mean, these have performed quite well in recent years, and we're expecting them to continue to do so, given the very strong economic growth backdrop that is representative there. In terms of underperformers, we think Paris actually pricing there is starting to look quite stretched in an environment where we think government bond yields are going to continue to rise. Though that said, there has been greater stability in corporate bond yields, which provides some comfort that we don't think property yields in the French markets are going to spike. Elsewhere, German markets, in general, we think Berlin is going to underperform because of looser supply conditions, which are limiting rises in rents. In the US, we would normally expect the US to outperform in the longer term because economic prospects are generally better there, but there's still some near-term weakness to come through, given the adjustment that we think is still needed to higher interest rates. And APAC, I mean, there's a lot of differences within the region, but in general, we think APAC markets will underperform, and that reflects still some adjustment needed to higher interest rates, but also the fact that economic prospects are generally weaker than we might think in the US and Europe, and because of that, we have a weaker rental outlook. So combined with lower income returns, we think that's the APAC region that's going to underperform the US and the UK.
And then when we think about sectors, I know you guys have done lots of work looking at, what's been happening traditional sectors, the past few years dominated by things like the pain in the office sector. But I also see a lot of emphasis on alternative sectors, lots of coverage of data centers worldwide, a lot of attention on that quite obviously, but also things like senior housing. Does it come down, Kiran? Does it come down to that split between traditional sectors, those are going to be struggling, look to alternatives for the returns?
To a degree, yes. So, one of the stories of recent years has been how structural change is affecting pretty much every sector, albeit in different ways. So we've seen, online have a negative impact on the retail sector, but be very supportive of long-term demand for industrial warehousing space. We've obviously seen the structural impact on offices like you just talked about. There's also this structural story about growing demand for institutional residential stock. And we're seeing that globally, and we're enhancing and expanding our coverage on the residential side in particular, which has kind of gone from maybe being an alternative in some markets to being very mainstream, even in those that were alternative maybe 10 years ago. But then also there are these structural forces that are driving other alternative sectors. So senior housing, as you just mentioned, is certainly a big one there, where we're seeing big changes in population makeups over the next 5-10 years and beyond. And so there's going to be increasing demand for that sector, which investors are very much aware of. And when they're looking at, a relatively tough story for some of the other sectors, then something that has strong structural supporting forces looks relatively attractive. And certainly for that sector, pricing still looks pretty attractive too. And so it also has higher income returns. And then there are other sectors as well. So kind of allied to that story about residential, there's been growth in demand for self-storage, and open storage came up quite a lot from clients again when we surveyed those who attended our in-person event back in November. And then, as you say, data centers, a very clear and obvious story over the last year, and I think that will continue to be as long as the AI boom persists. The rate at which those are being developed is rapid, and the size of those is also huge. So really big impact on the construction industry and the sector as a whole. I think one thing that we struggle with that sector to a similar degree that some of our clients do is just kind of fully understanding how much demand there will be and where the supply constraints might be on that sector. Certainly, power is an issue that often gets brought up, and so we've seen in Ireland, for example, a halt on development there because of stretches on the power supply nationally. But broadly speaking, there are also issues that are impending in other parts of the market where data centers are being developed. Virginia, for example, in the US.
You mentioned offices. Just very quickly, where are we in terms of the hybrid working debate? Has the shakeout in the office sector finished? I'm seeing more and more headlines about demand for offices, about deals being done. Are these isolated stories, or do they point to a broader trend?
It's an interesting one right now, actually, because you're seeing new demand for space outweighing the shift in reductions of space. So, the US has been the market where we have the best data and that's seen the biggest impact. And net absorption turned positive in Q3. We expect that to, broadly speaking, be the turning point. And so we expect to see relatively positive numbers going forward. At the same time, though, the data that we get from MSCI, which shows the impact on portfolios, has been turning increasingly negative in the last few quarters. So net operating incomes, which takes account of both occupancy and rents being received, they've been falling at a pretty rapid pace. So the 4-quarter rolling average in Q3 was minus 6.3% year on year. And that tells us that as leases are expiring, those spaces that tenants were in are being handed back to landlords, or maybe they were already handed back to landlords, but the space was still being paid for by the tenant that had vacated. So now we're really starting to see it come through on the bottom line. So you've kind of got this somewhat strange market where the pain is increasingly being felt by landlords now as leases expire, but at the same time, the actual fresh demand for space is actually turning positive. So for us, it means that returns are going to be weighed on over the next few years by these falling income streams for landlords. We talked about this back in 2020 when we wrote this long piece on it, and we're still pretty much in line with the expectations we had there, which was something like a 20% fall in operating incomes for landlords, because that combination of falling rental values and falling occupancy. So there's going to be more pain felt by landlords in the next few years.
I'll just jump in there because one of the flip sides of this is the demand for prime offices is really continuing to hold up. We keep wondering when the level of prices, the level of rents there will just seem too expensive compared to the rest of the market. But for now, it certainly seems like occupiers are still willing to pay for that space. And in an environment where, in general, the kind of new supply pipelines are relatively low, it looks like rental growth in those prime office markets is going to continue to hold up.
Yeah, and if you think about it in terms of affordability, then if a tenant is cutting their space by a quarter, they can pay roughly a quarter more for the new space they're taking. And obviously at the same time, they are, as Amy says, having to compete for staff and to kind of have the nicest space with great amenities close to stations. And, that compounds that factor and means that, I think it's pretty good support, as Amy says, for prime offices still.
So what happens to the old stock?
So this is gradually being converted or demolished. So Again, the US probably the best example at the moment because it has had the biggest impact, and it was already really oversupplied before the pandemic, to be honest, at a kind of national level. So we're seeing demolitions and conversions running at something like 0.7% of space per year at the moment. So it's ramped up over the last few years. That over the next few years is going to be faster than the pace of completions, which have dropped back to like 0.1, 0.2% of inventory per year. So we're going to see a decline of office stock in the US by around 0.5% per annum for each of the next 5 years. And I don't think it would end there. There'll still be more to come after that. But that's kind of the peak period, or we're kind of in the peak period of supply reduction, which again is something that we expected and said would need to happen back in 2020, and it's coming through now. In terms of what's happening with that stock, so I say some's obviously being demolished, some is being rebuilt or refurbished into newer offices, but a lot of it is being converted to particularly residential use. But that being said, a lot of it doesn't convert very easily to residential use. Either some is just nigh on impossible, but lots of other buildings it's not economical to do so. So there is some support out there from local governments. So again, in the US, lots of cities are providing incentives for developers or building owners to convert their space into residential because of this shortage of residential stock we've already touched on. But there's still going to need to be more support for that. And for those local city governments, it's in their interest really, because they need that footfall in their city centres to help other businesses thrive, and particularly in light of this reduction in office space and office demand. They've seen this big hit to city tax takes, and so if your building values are down, and particularly if proceeds from office tenants and owners are down, then they need to find other ways to support their required spending over the next 5+ years.
I don't want to wrap this up without asking where we see risks in 2026. When we think about like the big downside risk for 26, lots of focus on private credit markets. Is that an obvious place to look for risks in 26?
I think it is. We had this big regional bank flare-up in 2023, which doesn't feel like it was that long ago, but it's actually 2.5 years ago now. But we still think that there are issues on the lending side in the sector. It's quite a weird market at the moment on the debt side as well, because you've kind of got this two-speed or kind of bifurcated market where it's almost like, for a person, its head would be in the oven and feet in a very relaxing foot bath. You've kind of got this downside of high levels of distress, CMBS and delinquencies running at very high rates in the US, office delinquencies running at 11.5%, multifamily delinquencies rising. Amy touched on kind of the lack of distress coming through in Europe, but we've been concerned about some of the issues in places like Sweden and Germany for a while. And we kind of keep hearing, or we have until now anyway, kept hearing this story about extend and pretend and this survive till 25 moniker, which obviously is about to go out the window because nothing's really changed still. In fact, I was at a seminar a couple of months ago, and there was a question to the panel at the end about, what's the next kind of moniker? Are we talking about, back in the mix in 26, heaven in 27? It'll be dirty until 2030.
I'm going to have to stop you there.
And actually, the panelists, actually surprisingly to me, were actually pretty, maybe more honest than I would have expected. And they were very much in that last camp that, it's going to be a tough period over the rest of this decade. So, our story is kind of similar, really. Without a particularly strong recovery, I don't think this whole extend and pretend story or kind of strategy really works, particularly on the office side, where we don't expect to see much recovery in values and there's still downside risks. So, that's very much a risk where, I don't know, to some extent the risk is that nothing happens again, but actually in terms of like impact on pricing, then, the risk ultimately is that we do see some of that coming to market, or a large amount of that coming to market, and resetting prices at a much lower level. So that's certainly a downside risk. Like I said, the lending market does have this kind of two-way street where, on the other hand, we've actually seen data and surveys from like the UK Credit Conditions Survey, the US Fed Lending Survey, where generally the supply and availability of credit for real estate is pretty good or improving. We're seeing in the UK and Europe, LTVs are gradually climbing on new originations. So there appears to be this sign of an increasing risk tolerance from lenders on new loans. Also, at the same time, we're seeing massive CMBS loan volumes this year in the US as well. So there's certainly signs that lenders are willing to get involved with lending on new stock. And actually one of our stories, so we talked about interest rates earlier. One of the stories, if you think about that market and what it looks like over the next couple of years, if we're seeing a market where there's a low level of transactions, but lenders are increasingly willing and able to supply credit, then we will see growing competition between lenders, which is one of the reasons why LTVs are rising realistically. So we'll start to see margins fall back, and at the same time we're talking about interest rates falling in the short term. So actually, the cost of debt should actually start to drop back over the next couple of years, which will be supportive of volume. So you could look at that as an upside risk, where if that drops maybe more than we might expect, then there's definitely some upside support for volumes, and then that itself can kind of kickstart I don't want to say an upward spiral, because that sounds, probably the wrong phrase, but also it sounds a bit too positive maybe, but that's certainly the way it could go.
Kiran Raichura and Amy Wood on why this recovery in commercial real estate is so weak, but also where we expect to see outperformance and to end a potential upside risk for 2026. I just want to highlight the team's capital value indicators. These are available for all major markets and are tools that clients are increasingly reliant on to get a steer on the outlook and to capture turning points in the cycle. I'll also add some recent look-ahead analysis from the team to the podcast notes as well, so do check that out. Don't forget, if commercial real estate is part of your strategy, Capital Economics has all-access subscriptions that give you all of our global macro and market coverage, along with our CRE analysis, data tools, and a host of engagement options to get direct help from Kiran, Amy, and the rest of the CRE team. Get in touch to find out about Capital Economics all-access options at sales@capitaleconomics.com. And until next time, goodbye.